Hello. Thanks for listening to the Go Beyond Disruption podcast, where we share insights from inside the accounting and finance profession that help you stay ahead of the curve, whatever sector you work in. I'm Stephen Menges, and I'm based in the CPA.com AICPA Global Technology and Innovation Center for the Accounting Profession, right here in the heart of New York City. This week's episode is called Modernizing Your Practice and includes 3 experts on topics that are very relevant to many firms and organizations today. These experts provide some clarity around complex legal, compliance, and risk management topics facing firms in 2020 and beyond. First up, you'll hear from Ellen Goria, Associate Director, Global Professional Ethics at the AICPA's Professional Ethics Division, on the hot topic of firms offering both technology services in addition to audit and other assurance services. While we'll discuss at a high level various non-attest technology-related services, our focus today will be on hosting services and the new guidance from the AICPA's Professional Ethics Executive Committee, better known as PEAK. Since the hosting services interpretation became effective on July 1st, 2019, it's the right time to ensure you know the latest on these exciting non-attest technology services, and if there may be an impairment of independence at your firm that you'll need to address now or as your firm considers or rolls out technology-related services. After my chat with Ellen Goria, segment 2 of Modernizing Your Practice has Matt Towers, Product Lead for Assurance Services at CPA.com, speaking with Sterna and Sarah Ference, 2 absolute experts on liability and risk for public accounting firms, who will provide great insights for firms looking to grow and reduce risk at the same time. In segment 3, Matt speaks again with Sterna, this time about the implications of privity on third-party legal claims against accounting firms. Stan will help define privity and provide context around when and how it might apply in a lawsuit against a firm like yours. He also will discuss steps firms can take to decrease the risk of third-party claims and to limit liability to a third party. With me today is Ellen Goria, a CPA and the Associate Director, Global Professional Ethics at the AICPA's Professional Ethics Division. She is also one of the hosts of the very informative Ethically Speaking podcast. Welcome to our podcast, Ellen.
Thank you, Steve. I'm happy to be here.
Please tell our audience a little about your team, the Hotline, and how the team supports the profession.
Sure. The Professional Ethics Division wears many hats. We have technical staff available to assist with understanding your ethical responsibilities under the code. We do this through our confidential ethics hotline, where you can pose questions to the technical staff either via email or by speaking to a live technical manager through the phone, and through our toolkits and practice aids and publications that we prepare. And of course, through our podcast known as Ethically Speaking. The division also works very closely with the PEAK in its standard setting initiatives. And last but not least, the technical staff is also involved in enforcement activities. So the team is in a unique position to be involved directly with standard setting, interpreting those standards, and also enforcing them. If I may, I'd like to give a little plug to our hotline. The hotline can be reached via email at ethics@aicpa.org or through the main 800 number.
And that 800 number is that 888-777-7707, option 2 followed by option 3?
It is. You got it. Thank you, Steve.
I'm familiar with the hotline. Okay. So shameless plugs are fine on our podcast.
Okay. Excellent.
So why don't you tell us a bit about the new independence standards issued by the PEAK related to technology?
Sure, Steve. Over the past few years, the PEAK has tackled 4 technology topics. The first topic explored was cloud services. This discussion resulted in no guidance being issued because PEAK believed it should be clear that the provision of non-attest services on a cloud-based platform shouldn't by itself change the permissibility of the service. The second topic explored was cybersecurity services. While the peak decided not to issue any authoritative guidance, the research and the understanding obtained through this exploration, combined with the increase on the hotline, resulted in staff actually issuing some FAQs on this topic.
What is it that the staff thought would be helpful to communicate in these FAQ or frequently asked question documents?
Well, in essence, we concluded that independence would be impaired if the cybersecurity services involve the auditor designing, developing, or implementing clients' policies and procedures, or resulted in the member actually performing ongoing evaluations of the test client's controls as part of the test client's monitoring activities.
So what other topics has Peak explored?
Another topic explored was hosting services. The work in this area resulted in the issuance of a new interpretation and some FAQs. And we've also followed up with some podcasts based upon some additional feedback we've received. We're continuing to work with members on implementation questions. And so I think it's possible there could be some additional FAQs that might be issued, or perhaps, additional podcasts like this one. Before I really get into kind of a deep dive of hosting services, I wanted to just mention the fourth topic that Peak has really spent quite a bit of time on. This has to do with technology services that your clients might ask the firm or the member to assist them with. We refer to this as information system services interpretation. And this interpretation was adopted by the Peak back in May of 2019. It's basically a modernized approach to address these independence issues when you're helping your clients with various aspects of a technology-related process. It will be effective on January 1st, 2021, so we have a little bit of time. But at the same time, we are recommending that if you want, you can early implement the interpretation. So while this is or was the final fourth phase, I guess, of the technology initiative, it is by no way the last technology initiative. We just need to kind of rescope out what our next steps will be and repopulate the task force and keep going on from there. One more shameless plug, if I may.
Sure.
Going to keep doing this. In December of 2019, there will be an article in the Journal of Accountancy that will take a deep dive into the information system services interpretation. So I would really, it's an excellent article. It was written by one of our task force members. And so I would encourage you all to take a look through that article and begin the discussions at your firms.
Okay, so information system services is the new one, and there's an article to look out for in the December Journal of Accountancy. So good, that's good to know, and it's good to know that folks have some time to get familiar with that until that one takes effect in January 1st, 2021. So overall, it sounds like Peak has really been busy in the technology space, and as you know, Ellen, the topic I was hoping to cover today with you was also hosting services. So it's a topic that I've been researching for a long time. And there is a lot of thorough guidance and content out there on the new hosting services interpretation, including episodes of your Ethically Speaking podcast, which are excellent, by the way. And we'll link to all of them in the show notes, so listeners have a thorough list of content and guidance around the hosting services interpretation.
That's great, Steve. Thank you so much. Very handy to have it all put in one place.
So, Ellen, for the purposes of independence, what are hosting services that firms should not be providing to attest clients?
Well, Steve, before I get into answering just that question, I'd really love to kind of give you an overall concept of what hosting services are. from the perspective of the independence standard itself, because I think folks all have different perceptions of what hosting services might be. And so to level the playing field and make sure that the listeners all know exactly what we're trying to cover, I thought I would start with that. Would that be okay?
Sure.
All right, so I'm a visual person. So for those listening in, imagine a three-legged stool. And when you're thinking of hosting services, this three-legged stool will come in handy because in order for it not to topple over, you need all three legs. So if you were to provide a particular service that would get kind of scoped into our hosting services, you would remove one of those legs and the stool would topple over because your independence would be impaired. So just kind of keep that in the back of your mind as we kind of go forward.
That's a really interesting way to think of it. So what are the three ways that you can provide hosting services?
So the first way, I guess you could lose a leg or impair your independence, would be if you were to act as your test client's electronic security or backup service provider for its data or records.
So does that mean that the firm is acting as a business continuity or disaster recovery provider?
Exactly. That's a perfect example. Another way that you could lose a leg would be to be the sole host of one or many, for that matter, of your test client's information systems. And that would include not only a financial information system, but a non-financial information system.
So I get the financial information system, something like the general ledger, but what's an example of a non-financial information system?
Take a test client's website as an example. That would be potentially a non-financial information system.
So what is the third way you could lose your independence by providing hosting services?
Well, the final way you could lose a leg on your stool of independence would be to be the keeper of your, and this is a very technical term, so I don't want to lose your order or anything, be the keeper of your test client's stuff.
Stuff?
Yes, yeah, I know. Very technical. The chair of our task force, I don't know, it always resonated with me when she used this term. Think of it this way. You've agreed to take responsibility to be the holder of their data or their records, meaning that if they need to access this stuff, they'd actually have to come to you to get it because they don't keep.
I'm actually an old data storage professional from my years before coming to CPA.com, and we hosted other companies' stuff all the time. We weren't a CPA firm, though, so I guess we weren't at risk of losing a leg.
No, you weren't. No.
So despite all the guidance available, firms still have questions. How about we start with some simple questions that firms can ask themselves to quickly get a read on whether they may have an issue?
That sounds good.
The first question is kind of a two-part question that will eliminate some firms' concerns entirely. So let's start with, do you know for sure whether you're providing hosting services to any of your test clients?
That's a good one. So firms can think about the three-legged independence stool. If none of the legs are removed, then they aren't providing hosting services and they're not affected by the new guidance. But if they answered yes, well, then independent stool topples over and you know where that leaves you. You shouldn't be doing the a test engagement and providing that non-attest service.
And not every firm provides hosting services to a test client, so obviously they're not affected at all. I guess the real challenge is when the answer to that question is, I'm not sure. I'm not sure if I'm providing hosting services.
Yes, exactly. There could also be some challenges if the firm answers that it doesn't provide hosting services without really considering that, the three-legged independent stool, meaning that they're not really looking at the guidance to understand what hosting services are in the context of the code, where they're just relying on what they perceive to be considered hosting services.
Good point. In fact, where we find we're being asked lots of questions is in the area of portals. So I was hoping we could focus the remainder of the discussion on them.
Sure.
When a member, meaning an AICPA member, uses portals to communicate with their attest clients, do you think a good question for these firms to ask themselves would be, does my portal act as the sole host or actual or de facto disaster recovery solution for any attest clients' attest data or documents?
Yeah, I think that could be a good question for folks that are using portals. Obviously, if the firm is engaged to be the sole host of the attest client's data or records or their disaster recovery solution, the answer is easy: independence is impaired. So I really think what is key to your question is the whole notion or concept of acting as. One way to think of it could be whether or not there's a risk that your portal is being used to host the client's data or records, or being used at the client's disaster recovery solution. If the answer is yes or maybe, then wouldn't you want to take steps to make sure that your portal isn't doing that?
A question we frequently get asked as well is, does using the Rivio Clearinghouse, which is one of our products, our platform, does that result in providing hosting services?
Well, my understanding is Rivio is a third-party subscription clearinghouse that's used to issue attest reports, right?
That's right. Rivio is a platform and document repository designed to facilitate secure, source-validated document exchange between different types of users. Each user has their own user agreement with Rivio, including, the firm as well as the client and even third parties who may receive it. And Rivio Clearinghouse is the actual host of the clearinghouse.
All right, so I think the two key points that you've identified is that the third-party provider is the host of this document repository, and that the client and the firm each have their own user agreement. So I really don't see how this would result in the CPA firm providing hosting services.
So another question for portal users to consider would be, would any attest client have to come back to the firm and to the firm's portal to get documents that would be needed to provide to a new CPA firm because the client's records alone weren't complete enough in the case of switching to a different CPA firm? Is that correct?
Yes, that's a good test as to whether the firm providing hosting services via a firm or a third party's portal would need to make any changes to be in compliance.
All right, one more along those lines. Question they could ask is, if your firm must now terminate a client's access to data or records, are you prepared to complete the data or records purge within the mandated reasonable period after completion of the engagement?
Actually, Steve, this is one that the peak Hotline team has gotten, especially the reasonable period portion of the question.
Okay. So, Ellen, what is a reasonable period?
Probably folks are not going to like this answer. I'm going to have to tell you there really isn't a set period of time. You're going to have to use your professional judgment. I know we have folks that really like black and white answers, but this is not one of them. What I can tell you is that listeners will likely find it very helpful to ask themselves some questions. One would be, is the period of time practical in that it provides the client sufficient time to retrieve the information from within the portal while not causing the member undue hardship? And the other question that they likely will need to ask themselves in order to figure out if the period is reasonable is the period of time limited in duration and not extensive? If they answer yes to both questions, then the period of time is likely reasonable. Like one example, we can tell you we don't think it's reasonable to say the statute of limitations in your jurisdiction is appropriate, because many times that's like 7 years or something like that. That also is often similar to your firm's records retention policies and procedures, and we don't think that would be necessarily meet the the sentiment of a reasonable period of time.
It seems like kind of a common sense, like you said, personal judgment there. So one area we get asked about by firms is how would the new guidance be enforced? And what's the best way to ensure that their peer review goes as smoothly as they're hoping?
All right, well, let's look at the peer review. I do think peer review is always interested in the non-attest services that audit firms are doing.
After speaking to some colleagues about it, my question to firms would be, do you have a quality control plan for independence rule compliance in both peer review and non-peer review years? What do you think about that?
I think that's a perfect question to ask. And I really think the peer review team could probably make a whole lot more, provide more insight into what that might look like in the event that folks don't have that type of plan in place.
So I actually did check in with the peer review team, and they confirmed that peer review checklists do address independence of the reviewed firm at a high level, and that while examples of types of non-attest services are included, it's not a complete list yet. They also reminded me that it would be wrong for a firm to conclude that a reviewer would not make inquiries about types of non-attest services that a firm has provided to a client. So I'm really glad I checked in with them.
I seem to recall that there was a line of questioning, but I honestly don't think that peer review is the only way that this could come up. I think there are definitely other ways. The ethics division learns of potential non-compliance issues through our enforcement process. It can be from other regulators, from outside parties. There's really no limit to where we could potentially receive complaints. We have a whole enforcement process that would go through that.
It makes sense that there would be enforcement via a couple different means. Any final thoughts for firms?
Just two that come to mind, Steve. First, I would want to remind the audience that the rapid technological changes that we're experiencing are why guidance like hosting services and the information system services interpretations are needed. It's important to keep that in mind and not just refer back and think your memory of where the standards were is accurate. The other thing is the division plans to issue a strategy and work plan consultation paper soon. And one of the things that it will seek input on for standard setting is what should we be doing? And should it be standard setting? Should it be member enrichment? Should it be an enforcement project that we should undertake? So listeners that have ideas that they would like to share are encouraged to submit their thoughts. And if I can, one more plug for the hotline. Email us, ethics@aicpa.org, or call that main 800 number.
Okay. I'd really like to thank Ellen Goria for joining us today and helping firms as they innovate and digitally transform to better serve their clients. Okay. And then just a reminder that the show notes provide links to the guidance on this topic, as well as great additional content, including the AICPA Ethically Speaking podcast episodes on this topic, which feature Ellen and her team, including members of the Professional Ethics Executive Committee, better known as PEAK, and the Hotline team.
Thank you, Steve. Really happy to join you today.
That was the first of our 3 Modernizing Your Practice segments today. And I'd say the key takeaway from it is that as firms with assurance practices offer more of the technology services that clients want, they just need to ensure they're keeping up with the latest hosting services and other technology services guidance. The show notes include links to the guidance, and the ethics hotline that Ellen mentioned is also a great resource for firms. Next up, a discussion with Sterna from Aon and Sarah Ference from CNA, industry experts on liability and risk for accounting firms who bring unique legal and risk management expertise to the podcast. I'll turn it over now to my friend and colleague Matt Towers as he, Stan, and Sarah provide insights on the foundational best practices all firms need to know when it comes to engagement letters.
With me today is Stan Sterna, JD and Vice President of the Professional Firms Division of Aon Affinity, and Sarah Ference, CPA and Risk Control Director at CNA. Stan, Sarah, welcome to the podcast.
Thanks, Matt.
Matt, glad to be here.
Today, Stan, Sarah, and I are going to be discussing foundational best practices with engagement letters to help mitigate professional liability risk. To begin the conversation, we should really dig into why this is an important issue to tackle. So what elements of engagement letters are the key areas of focus to get right to help mitigate a firm's liability risk?
There's a lot of things that can be included in an engagement letter. But I think from a professional liability risk management perspective, there are three key areas that, firms want to make sure they get right when drafting their engagement letters. And the first one is the scope of service, which is, what you have been engaged to do, what services you are going to be delivering to the client. You may think that this is an obvious area for the engagement letter, but we do see a lot of disputes when it comes to identification of scope and misalignment of expectations regarding what the client thinks is being delivered and what the firm thinks it's delivering. So the more specificity and clarity you can provide in the scope of service within an engagement letter really just helps align those expectations. And I'll give you an example. Your engagement letter might say that you are engaged to prepare a client's tax returns. Well, what kind of return is that? Is it an income tax return? Is it a sales and use tax return? Is it a gift tax return? So identifying even the type of tax return is important. And then the question is, for what jurisdiction? Is it the federal return only, or is it a certain state? And if it's federal and state, well, which states? Again, getting as detailed as you can and putting a box around the scope of your service is only going to help, like I said, align expectations. And then if there is a dispute down the road, the firm can pull out its engagement letter and work with the client and say, look, this is what I was engaged to do. The second area of importance in an engagement letter is laying out the professional standards that the firm is going to follow when delivering the service. This helps set expectations regarding, what that level of service is. For example, are you engaged to, deliver a compilation service, or is it an audit? And that those two levels of standards are very different in terms of what kind of assurance or no assurance that is being provided by the firm. So laying out and identifying the professional standards that the firm is going to follow, and closely aligned with that is the limitations of that service. So for the vast majority of services that a CPA firm delivers, there is no responsibility to detect a theft or a fraud at a client organization. Yet we see that kind of claim in all areas of practice that a CPA firm performs. So, making sure there's clarity in the engagement letter that the fact that the engagement isn't designed to detect a fraud at the client's organization, or isn't designed to, and the firm has no responsibility to detect a weakness in the client's internal controls, or the fact that in preparing a client's tax return, they're not going to audit or verify the information that's provided to the client or provided by the client. So kind of setting forth the limitations of that service in the engagement letter, again, just helps align expectations. And finally, laying out what are the client's responsibilities in the engagement letter. It's to provide information timely, and maybe even, is there a certain deadline the client needs to provide their information by, so that the firm can actually prepare the return in a timely basis. You don't want to get information on April 13th for an April 15th deadline. Maybe advancing that deadline by which the client needs to provide information to the end of March, perhaps, or even earlier. And that allows the firm to manage their time. Other things with regards to the client responsibilities, if it's advice and recommendations the firm is providing in a consulting engagement, for example, well, laying out the fact that it's the client's responsibility to make decisions and to implement or respond to any advice or recommendations provided by the firm. So I think those are kind of of all the engagement letter provisions that there are and that are important from a professional liability risk management perspective. Managing that and providing clarity on scope of service, laying out the standards that the firm is going to follow, including the limitations of that service, and then articulating the client responsibilities.
Great, thanks, Sarah. That's extremely helpful, and I appreciate you providing the details around some examples there. So, Stan, with your background in managing claim defense, how does engagement letter construct come into play when a firm finds themselves facing potential legal action?
Matt, many claims deal with scope issues in terms of the engagement. Expectations maybe aren't clearly defined, or there is maybe not a difference in opinion, or maybe there's a difference of opinion between the client and the CPA with regard to what was going to be done. And unless you are being diligent, making sure there is a robust engagement letter process and procedure within a firm, as Sarah noted, you're going to find yourself sort of behind the eight ball when you're dealing with a claim, especially when the scope of the service is being disputed. So ineffective engagement scope management is going to obviously adversely impact the defense of a claim. So whenever I'm dealing with a claim, or whenever one of our defense counsel is assisting in the defense of a claim, the first thing that we look at or want to look at is the documentation regarding the scope of the engagement and what the parties agreed to. What the parties agreed to at a time when there wasn't a dispute between those parties. I mean, that's a key point because, hindsight's always 20/20. And people, especially attorneys, are going to parse words and try to draw different inferences from different things that were said or done. But when you have an engagement letter that was entered into between the parties at a time when there was a meeting of the minds and no disputes with regard to the engagement letter, that becomes a very, very powerful tool when defending a claim. So the engagement letter is sort of the first documentary evidence that we're going to look for in order to determine, how we're going to defend this claim. And if the claim centers, or a hallmark of the claim is based upon scope issues, obviously a document that memorializes the expectations of the parties, the scope of the services, the limitations of the services, is going to be central to our defense of a claim. So I cannot emphasize more the importance of having an engagement letter and documenting the scope of the engagement in terms of defending an accountant's professional liability claim. Because what you can do with an effective engagement letter, especially in a claim that is primarily focused on a scope issue, somebody saying, for instance, yeah, you're my tax advisor or my tax preparer, but I asked you about investment advice and you gave me a thumbs up on an investment vehicle and I lost a lot of money in that investment. The accountant will be sitting there and saying, well, we never agreed to enter into that kind of engagement. I was never engaged to provide you with investment advice. To be able to take an engagement letter and say, here's the scope of the engagement, this is what you agreed to, and there's no other documentation out there with regard to an investment advice in either in bills or in any sort of ancillary correspondence. I mean, that's going to be a powerful defense tool to respond to a claim. And you can really take the wind out of the sails of a claimant at the outset of a claim by having an effective and thorough engagement letter that memorializes the service agreed to. So I can't underestimate the importance of proper engagement letter procedures and having a proper engagement letter with all the necessary or the required elements that Sarah talked about when defending an accountant's professional liability claim.
I really appreciate that response, and really I think you both have hit on two really key areas. What should be in the letter, and why is it so important from a standpoint of defending a claim? I think the last piece I'd like to dig in with a little bit here is just any kind of recommendation you might have, or what you might consider to be the most important next step or a critical step that a firm should be taking today if they're not already.
Yeah, Matt, I have three takeaways that I'd like to provide to the listeners. Is one, obviously get an engagement letter. And get an engagement no matter what the service. A lot of professionals that I talk to will say, well, it's difficult to do that on a 1040 tax return. The expectation that your clients, you can have hundreds of these type of clients are going to issue or sign engagement letters. I would say that's not completely accurate if you're explaining to the client what you need, why you need it, why it's good for them, why it's good for the accountants. Level set the expectations. So in other words, implement a procedure in your firm to obtain annual signed engagement letters with all the relevant elements that Sarah noted when she was describing what you should include in an engagement letter. So that'd be number one. Obviously, get engagement letters, getting annual engagement letters from your client. Takeaway number two, review those engagement letters annually. So each year you're getting a new engagement letter. By having an annual engagement review process, you're sort of triggering yourself each year to not only evaluate the scope of the engagement, making sure that the engagement letter corresponds to what you may have agreed to during the course of the year with the client with regard to the scope, with regard to the limitations. And by doing this each year, you're sort of forcing yourself to review the engagement. And you can do it as part of your annual client continuance due diligence, reviewing the scope of the services, reviewing the communications you've had with the client through the course of the year, and making sure that engagement letter each year accurately defines the scope of the engagement. And last, and this is, I think, a very, very key takeaway with regard, especially with regard to defending scope issues and accountants' professional liability claims, amend the engagement agreement when it needs to be amended. So whenever the scope of the services change, document that change. If you're agreeing not to take on additional services, then either issue a new engagement letter or amend the existing engagement letter by maybe including an addendum to the engagement letter describing what the changes are. At the very, very least, if you don't do those first two, document in writing. And I don't care as a person who has defended claims for over 20 years, I don't care if it's via email, whether it's via a written letter, it can even be text. You should document in some written form the changes in the scope, because when we're defending professional liability claims, there's nothing more powerful than documentary evidence. I mean, when you have one individual saying, no, you agreed to do this, and the CPA may be saying, no, I didn't agree to do that. When there's no documentation with regard to what the meetings of the minds were or with regard to the scope, the claim will devolve into a what we call swearing contest. So it's going to be more or less one person is a he said, she said, one person saying one side of the story, another person having another story, and then it comes down to credibility, and sometimes a jury finds one person believable, even though that person could be the person who is misrepresenting the truth. When you could bring in documentation at the time the engagement was going on, as I noted earlier, at a time when the parties were in dispute, that's powerful evidence in a claim to say, no, you're mistaken. This is what we agreed to. And what we agreed to was not what you're complaining that I did not do or should have done. So the three takeaways that I would have: get engagement letters, have a process in place to get them, review them annually, and amend them accordingly.
And I would also add, it's very easy for us to say all these things, and it's harder to implement them when you've got the demands of delivering the service, growing the business, managing your practice. But having a good engagement letter in place is also incredibly beneficial from a business perspective for a CPA firm. If there's amendments or changes to the scope, well, that's additional service, and that could be an additional revenue stream for the firm. So in addition to helping manage the firm's risk, it also might generate some fee opportunities for the client, and articulating, what the service is and what the firm is going to provide, and managing those expectations with the client. Well, that's actually a very good thing from a client service perspective. And revisiting the scope of service every year allows you to not only manage your professional liability risk, but also help manage that client relationship as well. So, understanding that implementing and updating engagement letters is a incredibly onerous and could be perceived as an administrative task. There's a lot of resources out there to help firms. We as the professional liability carrier for the AICPA insurance program do provide sample engagement letters to our policyholders that we update on an annual basis. We have over 30 of them, including samples, terms, and conditions, which get you 90% of the way to creating your own engagement letter. So that's a resource for you. The AICPA, certain sections also offer sample engagement letters. There's a wide variety of resources out there to support firms. And what we would say is create something that's going to work for your firm and your client base. You know what your firm can do to implement. Your clients, but as Stan said, get something. in place with those clients and for every engagement, because at the end of the day, it's not only going to help the firm manage its professional liability risk, it's also going to help the firm deliver excellent client service as well.
Those are some really good suggestions and practical advice for people to take. Really appreciate your time today, Stan and Sarah. Thank you so much. And I'm sure everyone listening appreciates having a bit more awareness around some best practices for engagement letter creation and scope.
That was a great segment with actionable insights on a topic near and dear to the hearts of CPAs, engagement letters. Incredibly important to get those right and protect your firm while strengthening your client relationships. Next up, Matt Towers taps Stan Sterna, JD, again for a short but powerful interview on privity in third-party audit claims. Liability and lawsuits are real threats to achieving firm goals. So listen to the best in the business in our third and final segment today.
Stan and I are going to talk about ways that you can protect your firm against third-party audit claims. So Stan, to kick things off, I'm hoping you can provide a little bit of context around this subject for everybody. Just how prevalent of an issue are third-party audit claims for the profession, and why do they tend to happen?
Thanks, Matt. Yes, they're very prevalent. A lot of claims that we see in the accountant's professional liability arena deal with third-party non-clients suing the auditor. Audits are frequently relied upon by non-client third parties such as lenders or sureties as confirmation of a company's current financial condition when entering into a transaction with the entity, like a loan, a guarantee, or an investment. When the audit client later defaults on the loan, it may go bankrupt, or it may fail to complete a project, requiring a guarantor to finish it. These non-client third parties will often try to sue the auditor, alleging that they relied upon the audited financials to their detriment. But the only way a non-client has standing to sue an auditor is where there is what we call privity of contract between the parties.
Interesting. So maybe, if you don't mind, Stan, can you take just a little bit of time here to put a little bit more context around privity of contract and what that might mean for a firm?
Sure, Matt. The common law generally does not impose obligations upon any person who is not a party to the contract. So obviously, parties who enter into a contract have standing to sue each other per the terms of that contract. This is called privity of contract. So an audit client, in the context that we're discussing, obviously has privity of contract to sue the auditor, while most third parties that are not a party to the agreement cannot. However, there are exceptions. Under certain circumstances, state law will impose privity of contract for non-client third parties who are not parties to the initial engagement agreement. Today, there are three basic approaches to third-party non-client liability, depending on which state law applies, and I'll be happy to go through each. In the first approach, a third party must be in privity or near privity with the auditor to recover for ordinary negligence. For this to happen, the auditor must be aware that a known third party intended to rely upon the audit information provided to the client for a particular purpose. And this is important, there has to be conduct by the auditor linking it to a third party's reliance. A good example would be if the auditor was emailing or talking on the telephone with a bank lender. That would be conduct linking the auditor to the non-client third party. The second approach is often called the restatement approach. It is named after the Restatement Second of Torts. And basically, Matt, that's a summary of common law tort law in the United States. Section 552 of the restatement specifically addresses non-client third-party reliance. This approach is followed by the majority of states. And the restatement approach, liability is found when the third party is within a class of individuals or entities which normally rely upon an auditor's report. In such a case, if the auditor knew or should know of reliance by this class, reliance by the third party on the audit report is regarded as reasonable under law. So I'll give you an example. Let's say we have a situation when a client is negotiating a loan with a bank and it needs an audited financial statement. The client then hires a CPA firm to do the audit, explains that the purpose of the audit is to negotiate a loan. The auditor has a duty to the bank, i.e. the non-client third party, even though it was not a known third party user. This is because the bank is within the limited class of third parties that the auditor knew could potentially rely upon its audit report. And as I stated, the majority of states follow this restatement approach. The third approach is often called the foreseeability approach, and it's much more expansive than the previous two I mentioned. It's used in only a minority of the states, notably New Jersey and California. Basically, an auditor can be liable to any person under this approach whom the auditor reasonably foresees obtaining and relying upon that audit report. This includes both known and unknown parties. So it's much more expansive, as you can see, than the other two approaches.
Absolutely. This is extremely helpful information, and certainly I think everyone will want to make sure they're aware of what applies in their specific state here. So then, Stan, knowing the potential risk of third-party audit claims, what would you suggest that firms do to decrease the risk of a third-party claim or just reduce liability to third parties in general?
Well, I would give 3 risk tips to anyone that's having to deal with these issues. First, and it's kind of the obvious, but it still needs to be reiterated, speak with a lawyer familiar with the laws of the state in which you practice and in which the client and the third party are domiciled. By doing so, you need to determine the privity approach that applies in that particular state. I'd like to note, though, that I'm only speaking now of audits of private companies. Audits of publicly traded companies are governed by rules adopted by the SEC, so you should look at those rules as well. My second risk tip would be at the beginning of an engagement, the auditor should gain an understanding of the financial statement users, both known and even potential users. And consider this when performing a risk analysis during a client engagement, acceptance, and continuance process. Third risk tip would be the contact with third parties should be limited. So make sure you're limiting the communications that you have with third parties. This is especially important in states where the privity laws provide legal protection if contact is avoided. The fourth risk tip I would recommend is use an engagement letter to limit the use of the audit report and require the auditor's written consent before the report is distributed, published, or reproduced to users not specified in the engagement letter. Also consider using an indemnification clause in the engagement letter, which would require the client to defend and indemnify you for any claim by non-client third parties.
Thanks a lot, Stan. I really appreciate those insights into third-party claims against firms and what firms really can do today to limit their liability to third parties. Appreciate that insight.
What an interesting interview on an important topic for all assurance firms who audit private companies: privity of contract. Stan knows more about third-party audit claims than just about anyone. So this was great information and useful tips from the best in the industry. So that's a good place to stop for today. We've had 3 great conversations with experts in areas where we can always use some thoughtful, actionable thoughts and ideas. There's plenty more to explore about these topics, so our show notes will have links to all of the resources we've mentioned. To view them, just click on the episode's info icon in the podcast app on your smartphone or tablet, or open the episode in your computer's web browser. You'll find everything right there. I want to now mention that Modernizing Your Practice is also an ongoing program and content series with the goal to curate clarity around complex legal and risk management topics for firms and organizations of all sizes year-round. Found at cpa.com/MYP, you can access these 3 interviews and other pieces in the ongoing content series, which features a bevy of industry experts on key legal and professional liability risk topics in a variety of bite-sized and short to medium form content, all with an eye towards the transformation of today's audit and assurance practices. You can hear these 3 interviews separately and in their entirety at cpa.com/MYP, as well as share them or just learn more about Modernizing Your Practice or other thought leadership programs and content from CPA.com and members of the larger Modernizing Your Practice team. There are 2 other websites we'd recommend for listeners interested in taking this further. There's AICPAstore.com/Go Beyond Disruption and CGMAstore.com/Go Beyond Disruption. You can go there for courses, webinars, and other professional development resources that will help keep you ahead of the curve. Thanks again to all our guests today, and of course, thank you for listening. If you've enjoyed the episode, go tell someone about it. You can even email us using the feedback link in our show notes. We'd love to know what you think and what you'd like to hear more of. From the Global Technology and Innovation Center for the Accounting Profession in the heart of New York City, I'd like to personally thank the Go Beyond Disruption team in London for allowing me to host this week's episode. We'll be back soon for more conversations that help you and your profession to go beyond disruption. Till next time, this is Steve Menges saying thank you and goodbye.
Thanks for listening to this episode of Beyond Disruption, brought to you by the Association of International Certified Professional Accountants. Learn more about today's topic at AICPA-CIMA.com/disruption. This podcast is designed to provide illustrative information with respect to the subject matter covered and does not represent an official opinion or position of the Association of International Certified Professional Accountants or any of its subsidiaries or affiliates. It is provided with the understanding that the association, its affiliates, and subsidiaries are not engaged in rendering legal, accounting, or other professional services. If such advice or expert assistance is required, the services of a competent professional person should be sought. The association, its subsidiaries, and affiliates make no representations, warranties, or guarantees as to and assume no responsibility for the content or application of the material contained herein and expressly disclaim all liability for such damages arising out of the use of, reference to, or reliance on such material.